last show of the year. Jeepers. And what a year it's been, hey? That's why we thought we'd invite Stephen Nathan, the CEO of 10X Investments, to join us, just to have a look at general personal finance. Stephen is specific about retirements. That's the one thing that he concentrates on. But generally, Stephen, nice to have you with us, by the way. Generally, it's been a rough year, and we're going to get into a bit later in the show, into next year, but I don't think we're out of the woods yet.
No, without a doubt. I mean, it's been an incredibly trying year, and I guess if you put an analogy like a 400-meter race, we've only made about 10 yards, but most people have run a marathon because the volatility in the markets and the uncertainty has been quite exceptional.
We were having a chat the other day, a group of just general guys about investments, and it's very difficult to decide where to invest right now, because if you think about it, it's pointless. I suppose it's not pointless paying off your bond, but with interest rates so low, it's probably better to use the bank's money. With interest rates so low, it's pointless putting your money in the bank because you're getting nothing back. And from an equity point of view, the markets are tanking all over the place. So, I mean, what do you do? How are people investing?
Well, it's more, I think the question is, how should people be investing? And the reality is that we don't invest for 1 year. However, we're very influenced by what's happened in the recent past. So you're right that a lot of people are growing more skeptical and concerned about the stock market. But the reality is that for most people, the way to create wealth, returns above inflation, is through the stock market. So even this year, the stock market is actually up in South Africa. We're up about 6%. Now, that's not fantastic, but it's not disastrous. And I think a lot of people believe that they've actually lost money being in the markets this year, and that just isn't true. So when you're investing, the first thing is to identify your time horizon. How long am I going to be investing for? Because the longer your time horizon, then you should put in place a strategy that's appropriate for 10 or 20 years, and not look at it every quarter and every year and say, okay, well, what do I do differently now? Because you've got to have a sensible strategy that is appropriate to your time horizon.
But we're human beings. When things start going wrong, we do get nervous. And is that the time then where you should just go, whoa, hang on, don't even worry about it, just leave it?
Well, that's exactly why you've got to have a long-term plan, or a plan that's appropriate to your time horizon. So if you are a short-term investor, then you don't want to be overly exposed to the stock market, because times are calm. It doesn't mean that because we've been calm in the past that we're going to be calm in the future. We were calm in the past. Prior to 2008, we were very calm. People said, oh, risk is gone, and we're in a new paradigm, and it wasn't. So people had this false sense of security, and because, as you say, because we're emotive, prices were rising, we were buying all the time. As it became more and more expensive, so we bought more and more. And that's what you shouldn't do as a rational person.
But when it does come to investing, most people are not rational. Most people get emotional about it, and that's where they unwind themselves.
Well, that's why you need a professional who actually isn't emotional themselves. And I think a lot of professionals actually are emotional. But that's why you need a sensible plan. We talk at 10X about stewardship. Sensible practices, as if you were going to your doctor and you said, listen, I want a long-term health plan, for the rest of my life. Worry about what happened, I overindulged on my last holiday, therefore I'm going to extrapolate that trend. So you just need to be sensible about it, and you need the professional expert who is actually going to take that emotion out and not become a salesman and say, well, things are down, sell more, because that's what happens. In the crash, we all want to sell, but it's too late. The market's already down 50%, and in the boom times when the market's doubled, we all want to buy. And that's exactly the wrong time to be doing it. So the message, you're right, is we are emotional, and we have to try and become unemotive and pretty cold and callous when we look at our investments.
Are you trying to tell me you've got no emotion?
Well,
come on, burst into tears, come on.
A lot of studies have been done on this. It's called behavioral finance, and the economic theory assumes we're rational. But in practice, it's been proven that even the experts aren't rational. So often the people that are your mates and that are actually good selling financial products, because they're good at relationships and they seem to be able to connect with the average person, those aren't the characteristics you want in a long-term money manager. They actually use terms like psychotic. These are people that are very unemotional. They're not influenced by the environment as most of us are. So that's what you want to be.
The psychotic financial advisor. I love it. I love it. It's been a rough year, and I think a lot of people have taken a lot of hard knocks this year, financially. Going forward, let's start looking ahead now. What's happened has happened. We can't change that. We can maybe try and change what happens going forward. What do we start looking for here? What are there any trends that are starting to come out? Is there any light at the end of the? Is anything looking good? Because to me, it's not. I may be being psychotic.
Well, I think it's nobody knows. So unfortunately, I can't give you categorically, yes, it's looking fantastic or it's looking lousy. You mentioned earlier about where do we invest and what to do now. But the reality is that the markets are quite good at pricing this level of uncertainty and concern in. So if you look at offshore markets as an example, Europe, we know Europe has got deep rooted problems. However, the companies are actually in quite good shape for the time being, and the valuations are very cheap. So you can buy good companies on 6-8 times PEs, where traditionally you'd pay 15 to 16 times. So although the environment doesn't look good, the markets aren't expensive. So what should you be doing is just be sensible about how much money you spend in general and how much you save, and then allocate that, as I said earlier, according to your time, determine how much money should be in those more risky long-term assets.
Let's get back to your major bugbear, and that's the way that people invest on the markets. The last time you were on the show, it was what we discussed. Just give us a brief overview once again of your strategy for people who didn't see that particular show.
Well, I think the issue about investing is to have a sensible solution that's delivered at a low cost. And the important point is that the returns we're talking about are not generated by the financial services industry. So I can stand up as an economist or portfolio manager and tell you what I think, but I'm not going to add to the return. The return's created by the corporates. Corporate South Africa, government bonds, the global corporates. The financial services industry is one big cost. So the markets in the long run give you about inflation plus 5, a balanced portfolio. So that's what the markets give you. Every 1% that an investor pays away in fees to advisors, to asset managers, administrators, to helper upon helper upon helper, that comes between you and your money. So that's a liability, because you can't earn more than the markets give us in aggregate. So a 1% fee as a percentage of your assets is actually a 20% fee. It's a fifth of your real return. And most people for retirement, when you add up all the costs, they're paying about 3%. So 60% of their real return, the return that is available to grow and compound to create wealth in the long run, is evaporated.
So that's the return, just to come back to it so I understand this correctly again, that's the return over and above inflation.
That's exactly right.
Okay.
So you might see a fund saying we CPR plus 5 and CPR plus 7. You're going to get, on a balanced portfolio, approximately CPR plus 5 over time.
Okay. And if they're charging 3%, as you say, that's 60% of your wealth that they're actually taking.
That's exactly correct. And it gets worse because it compounds. So not only do you lose that 3% today, but the return you would have earned on the return, and that compounds. So you erode 75% of your available real return. So that's our big bugbear, is that investors can do no better than the markets in aggregate. The more people that come between you and your money, the worse it is for you. So you might see good or bad returns published in the media. You don't get those returns. You only get those returns net of everyone's fees. And unfortunately, the industry doesn't do a good job of disclosing exactly what fees you are incurring.
But surely you can turn around to your financial services provider and say, I want a full declaration of what fees you're taking off.
Well, you obviously can turn around, but there's no legal requirement, bizarrely enough, to disclose all the fees that you are being charged. And even in the large pension fund environment, if you look at what we call a benefit statement, a statement of how your pension fund, you'll see an investment return net of fees. You won't see that was my return before fees, these were the fees I was charged, and that is my net amount. So fees are not transparent. And although there has been some increased regulation around it, you don't know what you are being charged.
But surely, no, yes, I'm a bit gobsmacked, to be honest, because surely you are entitled to know what you're being charged.
Well, we think you are. I mean, it's almost as if you wanted an invoice.
Yeah.
So at the end of the year, you wanted an invoice that said, okay, these are the services we provided you, and these are the various fees, and here's an invoice, and Jeremy, you owe us 20,000 Rand for the year. Are you willing to pay it? That doesn't happen. But what does happen is that the industry takes off the 20,000 Rand. You don't know. You're pretty naive about it. But if you did know about it and you understood the long-term impact and how much of your investment was being lost through fees, then you'd be up in arms. But it's investors are apathetic. As a consumer body, they're apathetic. So the industry takes advantage of apathetic clients.
But I suppose as a consumer body, we are, and we've gone right off the subject here, but what the hell, it's the last show. As a consumer body, I think we're apathetic across the board as well, because on the other side of the coin, we don't necessarily go to Gareth Ackerman and say to him, I want to know what you pay for your loaf of bread, and so that I know what profit you're making when I buy that loaf of bread. So I suppose we are a pretty apathetic bunch.
Well, I think in general, however, the financial services industry is different from retail for a couple of reasons. I mean, the first is that it's a regulated industry. So I think the presumption that it's highly regulated, and because this is a reputable company, they're looking after me. And that presumption is wrong. It's just plain wrong. There's no fiduciary responsibility for them to look after you. Often are equated to a pharmaceutical company that hopefully they've got to have the drugs on their shelves have to be approved and have to be in your best interest and have to do what they say they do. Whereas the financial services industry, there isn't that level of oversight. So people have this presumption that I'm being looked after without any obligation on the provider for that. And also, if you go to Pick n Pay, you can see what a loaf of bread costs you, and you can go and compare that versus ShopRite and Woolies, etc. So. Whereas in investing, it just isn't easy. You can't. If I had asked you a question and say, which life company's got the best retirement annuity? I mean, they've been around for decades. There's a lot of track record there. Who's got the best retirement annuity?
Wouldn't have a clue.
No clue. No one has a clue.
Wouldn't have a clue.
No one has a clue because it's not disclosed. They all offer each other's products. There's a lot of there's lack of transparency. No one's got a clue. But if I had to ask you which retailer gives best value for money, you'd have an idea. You'd have an idea.
We're talking about, we've gone totally off the subject, but it is the last show of the year, so what the heck. We'll get back to the year ahead and see what we can hopefully expect and how we can try and make sure that we all end up this time next year with a little bit of money in the bank. It's time for an ad break. We'll see you after this.
There are many reasons to love